Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management, and we want to welcome everyone to another episode of the LifePro Market Update. We're certainly appreciative of all your time and certainly of all of your business and patience as we've made our way through sort of these choppy summer months. But the good news is that if we look at the strategy performance and everything else, we've definitely made a solid turn here over the last month. When we look at since that August 19th bottom, the strategies are up versus a relatively flat S&P 500 and actually up versus a down market here in the month of September. So we're going in the right direction. We have a lot of work to do, but a lot of our quantitative indicators are pointing here in the right direction. And we're going to go through all of that today. So let's go ahead and get started like we always do. And the title of this week's presentation is Making the Turn. COVID cases are plummeting now, and we're seeing rising economic confidence as a result. So what does that mean for us as investors? We want to be positioned for rising interest rates, which tend to be good for economically sensitive stocks. This stronger economy that we've been kind of pounding the table on here over the last few months is leading to a sharp drop in oil inventories and therefore rising oil prices. And you're starting to see that reflected in stock prices. Remember what we said, sometimes the price of a stock is not going to make sense over the short term, but give it enough time and that value will be reflected. And we're starting to see that. And then lastly, despite a lot of the market volatility over the last couple of months, credit markets have remained firm. We have not seen any rising credit risk in a lot of the CDS indicators that we look at or credit spreads, et cetera. So all of that is really good news. Trends are your friend. Remember that. When markets are in a positive uptrend, in a strong uptrend, and we get a spike in 20-day lows, we want to buy those spikes. That's really important, especially when we pair that up with a strong credit market. So what we see here is a very big pronounced uptick in terms of the percentage of stocks at 20-day lows. Those forward returns, when 20-day lows are greater than 50% of the market and in an uptrend, we can see those forward returns are above average here in the blue bars versus all other observations in the red bars. What's the bottom line message here? 20-day lows spike and the market's in a positive uptrend and credit markets are healthy, we want to buy the market. Now, in terms of the symptoms of the market, we're seeing a lot of positive symptoms. We finally broke that 50-day moving average on the S&P 500 and then quickly tested the 100-day, successfully tested the 100-day, bounced and recaptured the 50-day moving average. That's a good risk signal when we look at the technicals. Secondly, we're seeing a strong drop in the VIX. So VIX volatility is right back to where we started at the beginning of the week. The US 10-year interest rate, very important for our work and what we do, is back to cycle highs now. We broke above 1.4%. And then the financial conditions index, credit spreads, credit availability, cost of credit, all back to cycle highs in terms of risk being very, very low. So all of these things are very positive symptoms, despite some of those scary headlines we can hear about in the press. Let's follow the breadcrumbs. What we see here is this is the 10-year interest rate on the right. We broke above to 1.45%. With all those negative headlines, no one's buying bonds. People are selling bonds. And what are we seeing as a result? Those cyclical, economically sensitive stocks from a relative strength standpoint are beginning to turn up. And guess what's starting to turn down? FANG. Those technology leadership stocks, so Google, Apple, Netflix, Facebook, Tesla, those are starting to turn lower. Remember, we've been pounding the table on this for a couple of months. People are hiding out in these stocks. And now we're starting to see the downturn in technology. We're seeing the upturn in like energy, industrials, the banks, and we think we're in the first or second innings of this. So trend is our friend and we want to stay firm into that trade. In addition to that, we know, and we've been saying this for many weeks, cyclical flows are washed out. There was a correction in the market this week. We saw that 5-6% drawdown in the overall stock market. It already happened in energy. It already happened in industrials. It already happened with the banks. We see that here, the cyclical ETF flows deeply in negative territory. We see that the same thing in industrials, right? And now guess what's happening? The spread of performance between the Russell 2000, so those are small cap stocks, and the NASDAQ 100, which is dominated by Google, Apple, Netflix, Facebook, Tesla, et cetera, is at a record, is close to a record, is in that 5th percentile here. So what does that typically mean? When the performance spread between small caps and the NASDAQ is at a record wide, or at an extreme wide, I should say, we tend to see the Russell 2000 outperform going forward. The Russell 2000 tends to be very cyclical, which ties back to financials, banks, energy, materials, et cetera, which is where we are positioned in. So I think that's a really, really good symptom. So if we think interest rates are going to increase, what we want to ask ourselves is, what are the style of stocks that we want to own when interest rates increase? And what are the sectors that have the most historic sensitivity to rising interest rates in a positive way, right? We want to understand what are those sectors that go down in price, but what are the sectors that go up in price when interest rates go up? And what we see is that, first of all, value tends to outperform growth when interest rates go up. And the most sensitive sectors from a positive standpoint, in other words, the sectors that go up the most from a historical standpoint when interest rates go up, are energy, banks, and the financials. Those are our 3 key overweights in the portfolio right now. And we're seeing the action in crude oil. We've been pounding the table on this for months. When we bought energy stocks back in May, oil was around 58, 59 bucks. We're now sitting at $73. What did we say? We just need COVID cases to come down. We projected that on August 15th. It happened on August 19th. Those COVID cases to come down, rates to go up, to start to unlock that pent-up value that is being stored up in these energy stocks, because they're all making $15 more, 15 more dollars per barrel than they were just a few months ago, and the stocks were lower. We're now seeing those stocks break out. Again, sometimes stock prices can move strangely over the short term, but over the long term, the market becomes a weighing machine, weighing the good versus the bad. And of course, credit markets are absolutely intact. Level of implied credit risk here across the high yield sector, the chart on the right in the blue, near cycle lows, no real risk tea leaves being flashed at this point. And then we look at high yield sector spreads. Notice energy back down to cycle lows despite all the fear over the last 2 or 3 months. Discretionary, industrials, financials, all in the same, all with the same sort of action. Credit risk continues to fall, or at least implied credit risk continues to fall, and that's what we want to see. And then, of course, higher interest rates do tend to be a headwind for technology, which is where everyone else is invested right now. And we're starting to see that play out in how tech is trading. We see here ARK versus the NASDAQ 100, very similar to the action we saw back in 2000. So as interest rates climb that wall of worry, remember, we did this chart last week, and it was at 1.32. We're now back up around here, 1.45. Technology continues to underperform. We expect that action to continue. So overall, as interest rates break out to the upside and COVID cases decline, we do expect a lot of those key overweights in our portfolio to outperform. We expect that. We could be wrong. We can't guarantee that, but we think that energy, banks, financials, industrials, and of course, the material stocks are very well positioned here over the next few months. That stock market sneeze we saw earlier in the week and last week was not backed up by the credit markets. Credit markets continue to remain firm. 20-day lows spiked. We want to buy that dip. Pent-up value in energy, industrial, and bank stocks. We think that's set to be unlocked here as rates continue to increase. And of course, the key area of exposure right now where most people are overweight is technology. We want to be careful there. So that's our story this week. And if anyone has any questions, please feel free to reach out to your advisor, and they would be more than happy to assist. So thank you again for all your business, for all your patience, and of course for all your feedback. And Please have an absolutely fun and fantastic and safe weekend.